ourselves, we've kept the best till last. We have a marvellous panel here. I'm going to be quite fierce and keep them to time, because although some of us have the privilege of having them on speed dial, I know that you don't all have that, and so you'll want some time to be able to ask questions. It's been a fascinating 2 days. This panel is about energy, and when all said and done, energy is fundamental to the development of all other infrastructure in the African continent and elsewhere. Without energy, the economy cannot thrive, infrastructure cannot be developed, banks have no projects to lend to, and we core United sponsors have very few deals coming across our desks that we can actually get our arms around. We heard a lot about cross-border investments, and that of course includes power transmission, but we see very few of those yet. And to paraphrase one of my more cynical colleagues, cross-border transmission projects consist of taking power from people who don't have it to people who can't or won't pay for it. So we have a long way to go on power transmission, but we also need to solve the question of power that people don't have. Nowadays, you see all over Africa, sub-Saharan Africa, you see young people, even old people like me, with mobile phones. Those young people are doing their homework by candlelight, but they can see that the rest of the world does not operate like that it doesn't have to be like that. And we have a duty to try to solve that problem. The numbers are meaningless. Somebody said that earlier today. 5 billion, 10 billion, however much. It's not happening. The population of sub-Saharan Africa is growing faster than the percentage of people who have access to electricity, and that's a disgrace. We've got to fix the problem. So how do we do it? How do we change the model? I'm going to ask my distinguished panel to give us some suggestions and hopefully some answers. So, Elizabeth, I'll start with you. Elizabeth is the President and CEO of OPIC, and it's no secret that OPIC has been a catalyst and a champion for investments into African energy projects. OPIC has been a great leader in this and is playing a very important, increasingly important role. I'd like to ask Elizabeth to tell us how she sees OPIC as a platform to catalyze co-investments in the energy sector.
Thank you very much, Helen, and thank you for those great opening remarks. We're actually very excited that thanks to the confluence of a number of factors, improving investment climate that's boosted economic growth, a reduction in absolute poverty, and technology costs coming down so dramatically, that Africa has really taken the lead in being creative and moving ahead faster than any other continent on the mix of energy between renewables and fossil here. Last year, you know this obviously, Helen, but last year, 2014, Africa added more renewable energy than in the 14 previous years combined, which is a better record than many other continents can say. So OPIC has actually been a beneficiary and very privileged to take part in that. Since 2010, when we determined that renewable resources would be our key sector priority, we've seen our portfolio grow tenfold in Africa on renewable energy, and actually 100-fold since 2008. We're financing everything from large-scale geothermal like Ormad in Kenya to a solar facility here in South Africa to large-scale wind projects like Turkana in Kenya and Taiba in Senegal. Each of these facilities bringing dramatic reductions in costs either to the off-taker or to the end consumer. So we've been very excited to take part in this. I should also say that we have a significant number of natural gas deals too, so it's not just renewables at this point. And this really is sort of emblematic of what we're doing across the continent. Our portfolio in Africa itself, across the board, is not just renewable energy, it's infrastructure, health, education, water, etc. But here too, our portfolio is growing significantly. We're doing about $1 billion a year in financing and insurance on the continent, of which a significant portion is in the renewable sector. I'm happy to talk about challenges, but I'll leave it at that for now.
Oh, well, thank you. It's just one question, perhaps.
I think it's my observation, at least, that OPIC has become increasingly elastic in its interpretation of American nexus and American content. Perhaps you could just explain a little bit about how you work differently from US Exim, for example, and how you interpret the American connection.
Well, this is off the record here, right? There's no members of Congress in the room, I think. Okay, good. We are required to have a portion of a U.S. beneficiary somewhere in the transaction. And the rule of thumb for us is that 25% of the equity in the project needs to be a U.S. flag or U.S. passport. But of course, as we all know, the equity can be 25% of the project, so that's actually only 6.25% of the total. What we've liberalized recently is to say that test, that U.S. Nexus requirement, can be met not through equity, but through other arrangements like EPC contracts, O&M contracts, franchise arrangements, even surety bonds, or some combination of those. So it's made it a lot easier for us to deal with, to be able to support organizations like General Electric building wind farms when they may not have any equity in the project, but they've got a long-term contract.
I'll go along in order. Keiko, I'll come to you next. Keiko Honda, whom I'm sure many of you know, is the Executive Vice President and CEO of the Multilateral Investment Guarantee Agency, MIGA, and a great champion of projects in sub-Saharan Africa, which is what we're talking about today, Keiko. MIGA has been in the forefront of risk mitigation instruments to facilitate private sector investments and investments by funds in projects in Africa. Keiko, can you give us some examples and show how you feel that MIGA is in a position to facilitate new classes of long-term investors to take early stage risk? We heard in the previous panel, and we thoroughly endorse it, it's that early stage risk that is so difficult for your traditional investor to manage. And how is MIGA able to mitigate those risks?
Thank you, Helen. MIGA is the youngest agency among the World Bank Group, and we provide the two products. One is political risk insurance, another one is a credit enhancement. Through the political risk insurance, we mitigate the risk of transfer conversion, civil disturbance, expropriations, and a breach of contract of the government or government-related entity. Well, I think in South Africa, I understand 882 million people living, but power generation capacity is only 68 gigawatts, which is 75% of that of Spain. In addition, 65% of those 67 gigawatts resides in only one country, which is South Africa. I personally think Africans deserve better. As Helen, you kindly introduced, we've been supporting private investors coming into African continent, not only in South Africa, but Kenya, Cote d'Ivoire, Cameroon, and so forth. But I think one thing we, as a World Bank Group, along with the other multinational development banks, try to do is increasing the private investment from billions to $1 trillion. To do so, what really need? What's really actually needs to excite private investors to come in here? I think one of the key is the risk mitigation. Well, to increase from the billion to trillions, we need to expand the types of the private investors. At this moment, what we actually, what at least I'm seeing is investors coming into South Africa is either very, very savvy equity investors or the very large multinational commercial banks. What we can do to expand or bring the other types of like medium, even like a small size of the commercial banks or a pension fund and the insurance company, I think they are looking for slightly lower return, but medium or maybe lower risk. MIGA's risk insurance definitely gives a lot more comfort to the private investors. With this, I think in Africa, we are successfully bringing in more private equity firms, which led up to new type of investors in energy sector in Africa. Let me give a couple of examples. We brought Actis, which is a private equity fund, bringing in $290 million to Cameroon for multiple power projects. Also, Actis's affiliated fund, Global Egg, went to Uganda and Cote d'Ivoire. In addition, this is actually not the power sector, but Silverland went in. This is another private equity firm, went in, agri-sector of Africa, and came here with me today. I think she's sitting in the back. She's actually the engine bringing those funds. I think we really have to think about more risk mitigants, probably including different sets of investors taking different stages of the risk. Construction phase risk is higher than operational time. So can we actually slice the risk and structure the different way? But I also have to tell you one important thing. Bertrand Badre and my colleague sitting here a couple of panels before was telling, it's not really easy to make it happen. Yes, those risk mitigants have to be market tested, and then that takes a longer time. Miga happened to have 27 years record of successfully mitigating risk. I think we are public goods. I really appreciate for you to think about it, how you leverage us. And we like to be innovative, we like to change ourselves to make things better in Africa. Thank you.
Thank you very much, Keiko. Stirring stuff. Dana Hyde is the CEO of the Millennium Challenge Corporation. I think it's probably fair to say that a number of people in the room won't know exactly what the Millennium Challenge Corporation does. You do a lot of grant funding in order to encourage projects into a position where they can then be sustainable and can be funded.
Yes.
So tell us a little bit about how you do that and how you become a model that could be emulated more widely.
Thank you, Helen. So the Millennium Challenge Corporation was created just over a decade ago as a very unique model of development assistance. So the first to understand is that it is 100% grant assistance by the U.S. taxpayer, by U.S., and that the MCC has just one mission, and that is to alleviate poverty through economic growth. So over the last decade, MCC's investments are a 5-year compact, is what it is called. On average, they have been roughly $400 million over a 5-year period of time. And we take roughly 18 to 24 months to shape that investment. So the agency is funded at about $1 billion a year. And over the decade, 65% of our portfolio has been invested in Africa. And of that, 70% has been invested in infrastructure, roads, transportation, but increasingly energy infrastructure, transmission, distribution. And the model itself is very much premised on the idea of incentivizing governance. So countries are selected largely on the basis of a series of indicators reflecting governance performance. So right now, MCC has about $4 billion invested in Africa. We are shaping 6 compacts in 6 different countries. And interestingly, we are focusing solely in many countries, Ghana being the most recent example, on energy. And our approach in energy is really threefold. First, to focus our grant resources in areas that are traditionally the public good. So often that will be transmission or distribution. Second is to use our grant dollars in partnership with countries to help catalyze private investment. So often that would look like our own use for viability gap financing or the like. And then third, and importantly for us, to focus on the reforms, the policy, the overall enabling environment that will allow not just MCC's investment to be sustainable, but other private investment as well. So we are working closely with countries on regulatory reforms, on standard PPAs, on cost-reflective tariffs, and the like, in order to achieve that.
Thanks, Dana. So we've had three very committed expressions of interest in financing projects in sub-Saharan Africa. So now we can turn to two people who are the happy recipients of some of those funds, or hope to be. So I'll go to James next. James Mario, who's the CEO of Centum. James, tell us about what you're doing in Kenya and in East Africa in terms of crowding in, not crowding out, other co-investors. Thank you.
Thank you very much. Centum is the largest investment company in East Africa. And our focus is exactly what has been addressed here. It's about identifying that gap and focusing on developing opportunities and presenting investment grade opportunities of scale to investors. We're involved in a couple of sectors, but focusing specifically on power, we are currently working on 3 projects of varying scale. I'll start with the smallest. The smallest is a 2 megawatt solar power project, which is part of a captive project for a city that we're developing called Two Rivers. So Two Rivers is the off-taker of the solar power plant. The second one is a 70 megawatt geothermal power project. We have a 20-year power purchase agreement with the Kenya Power and Lighting Company. And the third one is a 960 megawatt coal power project with a 25-year power purchase agreement. This is the largest independent power project in the region. It is part of the LAPSET corridor that you heard about earlier. It's going to be the single largest generator of power in the country, and it's the cheapest at 7.8 US cents per kilowatt hour, and it's going to be baseload power to the grid. So to come to your question of what we are doing is we see our role as a developer and as an initiator of projects of scale. So if I take the Lamu Power Project as an example, you have 4 distinct stages of the project. You have the tendering stage. This particular project was competitively bid, and the bid was the award was on the basis of technical and financial proposal. Who offered the lowest tariff? We offered the lowest tariff. The second stage is the development stage up to financial close. Then you have the construction stage and the operational stage. Now, what we found from experience is that the majority of financial investors want to participate, but they do not wish to take the tendering risk, they do not wish to take the development risk, they do not wish to take the construction risk. They want to come in and participate in an operational project. Now the conundrum is that you need the funding to get financial close. So how do you bridge the two? And the second thing we found is that in our market, where we've had at least 12 or 13 IPPs over the last 18 years, there's been very few secondary transactions after financial close. So there's been no opportunity for pension funds to come in. So the way we've structured our project and the way we are currently working on it is that we've underwritten the financing all the way to financial close. We are, however, engaging with pension fund investors and other financial investors to invest by way of a convertible instrument where we draw down at financial close, so that once we achieve the conditions precedent to financial close, then we draw down, so that you as an investor, they're not taking any development risk. So if you don't get financial close, there's no drawdown of your investment. But then the second risk is around construction. So during construction, 3 things can happen. The project can delay, the performance it may not perform as expected, or the cost may escalate, and financial investors don't want to take that risk. So what we are doing to address that is then to allow them to convert into equity after the commercial operation start date. So the commercial operation start date is a point within the project when 90% of the output has been tested. So at that point, that particular investor is not taking a cost risk, is not taking a delay risk, is not taking an operational risk. And then they come in and become ordinary equity investors. So what that has done is that it has allowed us to be able to target investors as small as $100,000, because they do not have to understand the ins and outs of our power purchase agreement, an EPC contract and O&M contract. They don't have to take site acquisition risks, environmental risks, etc. The second issue has been the knowledge gap. You know, when you're talking to a financial investor and you want them to invest in infrastructure, there's a whole knowledge gap and understanding. Now, an investor does not want to spend $100,000 in due diligence costs to invest $1 million. So the issue has been, how do we democratize, or how do we make the investment more accessible? So what we've done is, as part of the due diligence process to help them, is to get independent due diligence reports on areas of tax, financial, technical, and legal, so that then you're not going into a data room and looking at power purchase agreements, O&M, looking at drawings. You're looking at a document that has been prepared independently, that is fairly credible, and then it allows you to focus on your due diligence areas. That has also reduced the period. And the final thing that we've done is tied to the point on capital markets. In our market, there's an initiative around development of asset-backed securities. We've been engaging closely with the Kenyan Capital Markets Authority, and we are working on developing an asset-backed security which is going to be dollar-denominated once a project is complete, because when you're holding the equity instrument, you're entitled to a stream of dollar cash flows. And that ABS, which we're now working on approval, then creates an exit for the financial investor who has come in. They then know down the road they can convert into an ABS, and that ABS gives them the liquidity that they desire. And you have insurance companies that want to create dollar-denominated liabilities, dollar-denominated education policies, etc. They now have a long-term dollar-denominated asset to play with. So that's what we are doing around the development, and those are the specific steps we've taken around crowding in investors who would otherwise not have access to infrastructure projects of this nature.
Thank you very much, James. I think that's extremely interesting, because it's illustrating the problem that many of us find in the sector, that on the one hand, the different risks in the different phases of project development are not easily managed by the same investor. And on the other hand, those of us who project finance our projects, which is the way certainly most power projects are done nowadays, find that there are significant penalties attached to taking out the lenders at 2 years post-construction, because the lenders have done a lot of work, everybody acknowledges that, and they expect to be there for reaping the rewards of that work for a long time. So finding a mechanism so that they can be taken out and rewarded, at the same time bringing in the pension funds and allowing those lenders to recycle their funds, is a problem that many of us are struggling with. And I know that Andrew, who chaired the previous session, is working with FMO, the Dutch Development Bank, to find a solution to that, to devise a solution to those different phases of the project development cycle. Now, I would come to Sabina, but you will notice that Sabina has morphed into Kevin Pillay. She was called away, so we have Kevin Pillay from Siemens at the end of the panel there. And Siemens is well known for investing in energy projects in sub-Saharan Africa. Perhaps, what do you do as an engineering company, as Siemens, to identify good projects? We hear a lot about there aren't enough good projects, there aren't enough bankable projects coming to market. How do you, Siemens, pick and choose between, you must see an awful lot of projects that you know will never see the light of day. How do you identify the ones that you think are worth pursuing?
Yes, okay, so I think we're always eager to look at more. There's never enough, so if you've got money, we can always do much more. I mean, Siemens is a German engineering company, and at the end of the day, there's two important things that I can think of that we focus on. One is, when we get involved in a project, we must be able to bring value to the project. The second thing is, it must be sustainable. And there's two parts to this sustainable part. One is on the financially sustainable for us, and for the partnership that's working together on it. The second thing is from an image perspective, because for big companies like us, the biggest factor is reputation. Your reputation precedes you, so you got to make sure when you get involved in a project, you are able to deliver what you started doing. Otherwise, and in these big energy projects, you're always fighting, and that never leads to anything successful for you or your partners. So firstly, we must make sure that we can protect our reputation. Second thing is we must deliver so we can keep our reputation. Then we come into other factors like we have a close look at our partners, because at the end of the day, the projects run over a period of time. It's not dependent on individuals. It starts off being dependent on relationships, but you need a process, you need a structure, you need a contract that stands in when a relationship doesn't work. And that's the bottom line about how things are working in the world. So we really look for that, and we look for partners that are equally reputable, partners that will stand to what they've done. We are a very transparent company. We don't want to get involved in issues of collusion. We don't want to get involved in anti-competitiveness. We want no corruption. So those are things that we focus on that are quite important. That keeps the sustainability element going through. Other things that are very important, and some of the colleagues touched on it, is risk. So country risk. What can we manage? What can we change? How would we react when things change that we can't manage something? What would we do? And that's quite important, that we go through these scenarios and we decide, okay, this is something we can go for. We can manage, or 2 out of 10 risks are a little bit more difficult to manage. These could be the scenarios, but the 8 we can tick off, and we go for that. And especially doing business in Africa, you've got to really think about these scenarios. The reality is that we, like most other companies, you've done good projects and you've done bad projects. The bad ones follow you for a while. Personally, professionally, reputation, everything, it follows you. But you learn your best lessons from them. And this is also what you've got to pass through the organization, so others don't forget that in time. And we work with focus countries. So Africa is a massive continent, very diverse, very difficult, logistically, I have to say, quite impossible to deal with in some places. We meet a lot of people from other parts of the world who are very naive. They will learn their lesson in these countries. Culturally very divided, and then you got to have flexibility. So we work with, for example, Portugal in Angola and Mozambique, because that makes sense. It's not for the South African leg of the organization to learn Portuguese. You know, we really transform ourselves to the requirements of what's needed to make a project successful. So those are the important things that we focus on. Through that, we have achieved a good record, especially in wind. A lot of the wind projects in South Africa, Jeffreys Bay, Sierra Wind Farm that we've done, North Africa, Tarafaya, for example. We're working in Mozambique with several projects, mixture of private customers and government. But it's going into it with the right mindset, long-term mentality, analyze scenario yourself up front, and stick by what you started off with.
Thank you very much, Kevin. The mention of focus countries, I notice Andy Herskovitz sitting in the audience there. I would be very remiss if I didn't make mention of Power Africa, which of course did start with focus countries. Elizabeth, do you want to say a few words about that?
Sure, absolutely. So I think most of you know that President Obama announced the Power Africa initiative because he felt so strongly, as you do, and we all do, Helen, that 600 million people on the continent without any ability to have regular access to power was unconscionable, and this was something that we have within us the power to address. So the initial aim was to double access to energy across the continent, with a commitment of $7 billion by U.S. government agencies at the outset, to be available not just in the 6 countries, but across the entire continent. 6 countries are really the focus of the transaction advisors coordinated by USAID. And I've got to say, we're frankly, the $7 billion that was committed is easily going to be exceeded, I believe, because we're all demand-driven agencies and we're seeing a lot of interest for financing across the entire continent, so I think we'll do more than that. And what I wanted just to say is that what we've seen in Power Africa, which has been, as you said, so ably coordinated by Andy and his team, is basically 3 things that I didn't expect, which have been a testament to its success already. As you know, developing power is a long-term game, so we shouldn't be expecting immediate returns, but we have seen immediate returns in 3 facets. One is we've seen developers coming to the table that were not even thinking about Africa before. Some American developers that weren't even thinking of investing outside of the U.S. So we've seen a lot of new interest, sort of wondering, what is this Power Africa thing? And we've seen real action on the part of those developers. Second, we've seen an unprecedented level of coordination amongst U.S. government agencies, including regular meetings amongst us all, and the ability to have developers come and meet all the agencies that could be relevant to their work at the same time. And third, thanks to the work of the transaction advisors and AID, we've seen transaction-specific support brought to bear on specific projects being worked on by OPIC, for example, that wouldn't have been available otherwise. So, for example, advice to extend power purchase agreements, or grants to provide legal advice to governments that don't have the funds to provide that advice. So, transaction-specific advice and grants that move transactions forward more quickly than they would otherwise be able to do. So those are the 3 things that I see already as evidence of success with the program. And again, Andy's done a great job with the AID team of coordinating all the U.S. government agencies whose resources are being brought to bear on this goal.
Thanks, Elizabeth. Keiko, are you seeing, we've heard today that there is more activity, that there are more things happening, not just in the energy sector, but in infrastructure in general. Are you seeing that reflected in the number of projects that MIGA is being asked to support? And are there particular areas where you feel that you could be doing more, or that you're perhaps overstretched?
Well, I think in the beginning of South Africa, we actually primarily focused on infrastructure, actually namely power. But at these days, we're expanding to transportation, including bridge and railway and so forth, then agribusiness, and then we would like to do more manufacturing. Yes, of course, power is the bread and butter of the business. Having said that, we also kind of need to create the jobs so people actually really feels the meaning of their life. I think we like to kind of moving toward that way. That's our intention. Yes, of course, private investors are not necessarily there yet, but I think, since we are able to provide a meaningful risk mitigation for the private investors, so therefore one of our role is also guide private investor into new area, as well as we expand the private investor base to going into such area. That's we would like to pursue.
Thanks very much. Dana, we often hear, and we say it ourselves, that what is needed sometimes is advice and support to governments. Not everybody understands the ins and outs of project finance. It's a bit of an esoteric discipline, and it's often felt that governments could be assisted by having really reputable, independent advisors acting on their behalf, giving them counsel. And I know you've been doing quite a lot of that. I've personally come across you in Malawi and in other countries. So can you tell a little bit about what you're doing on that particular capacity building front?
Thank you. So thank you, Helen. It's absolutely true that MCC's approach, and I referenced this briefly, is a very holistic approach above and beyond a specific project. So that we will often engage first with the economists in one of our partner countries around an analytic constraints to growth analysis to identify impediments to private investment infrastructure, but then to include a policy environment that surrounds that infrastructure that will support private investment overall as well as MCC's particular investment. So I think the commitment that we make to countries, which will be essentially a 7 to 8 year window, that we will be a partner with the country, and that the way in which MCC approaches the partnership, that is without any sort of preconceived ideas of particular areas or particular needs, but in a collaborative way and a very data-driven, evidence-based way that ultimately gets us to an area of focus. What we hear is that it is a very trusted and a very valued partnership. And as part of that, we are absolutely focused on the governance issues, not just the governance and technical capacity issues in a particular sector, be it transportation, be it energy, but the overall governance issues related to rule of law and judicial systems and sanctity of contract and the like. So that is the heart of the MCC model, and of course we are providing grant assistance, but we are very mindful to use those resources in a way that is much larger than the dollars themselves.
Great, thank you very much. James, I'm going to be slightly controversial with you. You mentioned a very large coal project that you're developing. How confident are you that you're going to be able to finance that? Because so many of the traditional lenders to Africa will not touch coal for well-known reasons. So are you confident that you'll find the funds to build that project?
Thank you for that question. The project is approximately $1.8 billion, 75% debt, 25% equity. We've sewn up the debt more or less, the 75%. The EPC is Chinese. The senior lender is Chinese as well. We have a smaller component, $200 million, which we are closing. The equity component is about $400 million. We are putting in about $150 million of that. We have interest for the 250 that is left. We have interest for about $500 million from various investors who are doing due diligence. So I'm fairly confident we are going to close. We are targeting to get to financial close in October. It has a 42-month construction period. Just with your permission, I want to address the second aspect, which is the perception of coal and why this project in the context of when one looks at Kenya, Uganda, and there are other sources of power, renewable sources of power. So the point is that as a country, we want to increase power generation from around 1,700 megawatts to around 5,000 megawatts. The electricity penetration rate is about 22%. 22% of households have access to power. And when you compare Kenya and its largest competitors in Africa, Egypt and South Africa, our per capita installed power is about 3% of Egypt and about 8% of South Africa. It's very, very small. So there's a push to increase. And the mix is from both renewable sources and other sources. So there are big renewable projects like the 300 megawatt Turkana wind project. Now the issue, however, is the following, is that with a lot of the renewables, let me take wind as an example, it's not baseload power. For you to sustain 300 megawatts of wind or 400 megawatts of wind in the grid, you need about 3 or 4 times that power as baseload. So as a country, traditionally our baseload power has been hydro. Now hydro, we are having challenges with the diminishing hydrological conditions in the country. So you need another source of baseload power that is affordable, hence coal. We've looked at geothermal, and Kenya is blessed with huge geothermal resources. Now the challenge we've experienced with geothermal, also being a developer of geothermal, is the amount of time it takes to develop the resource. So if you want to develop 1,000 megawatts of geothermal resource, it takes a long time. Now the advantage of coal is it's cheap at 7.8 US cents. It's the cheapest source of power in the country. It is quick installation time. It is base load, and it's perhaps substituting more environmentally damaging sources of energy that are currently in use at the moment.
good on you. Thank you very much. Kevin, I'll be slightly provocative with you too. We have seen one of your big rivals, namely GE, beginning to move into project development because they feel that there are not sufficient good projects coming across their desks. Are you tempted to do the same thing, or do you not see the need for that?
I think we're already doing that, just like our competitors. We have our own in-house project finance area. We are able to raise finance for projects. We're able to partner with other institutions, KFW, etc. So we're already doing that, and we're already funding some of the projects and pushing them forward. And I think it's a space that we have to play in. For me, what is quite concerning is the reality is, like we have alluded to before, when you go to the continent, you see a lot of Chinese, more and more and more. And I'm also saying to companies like Standard Bank, we don't see these guys there, or it doesn't come out compared to the Chinese. And we need to see a lot more mixture in there for a healthy, full competition. So we need more aggression from the Western North Americas and the Europe, basically. And I think what they are waiting for is a lot of pre-feasibility information, going through that thorough process. And in most places, the continent just doesn't have the time or the patience for that. Whether it's right or wrong, it doesn't matter, but that is mix I would like to see change personally.
Yes, it's an interesting observation. I think at every conference, people cite the famous Moody's report that shows that project finance deals in Africa are incredibly robust. There is almost no failure at all. But that is precisely because they are so highly structured, as you've alluded to. So with that, I'd like to turn it over to the floor. I'm sure that you've got all sorts of questions for my distinguished panel. So please say your name clearly, I'm rather deaf, and say what your organization is, and if relevant, to whom you're addressing your question. Barbara.
Thank you. Barbara Samuels, Global Clearinghouse for Development Finance and Vice Chairman of the FFD Business Steering Committee. It's really glorious to see you all there with your instruments and your innovative approaches to get finance. But 2015 is a year of definition. How do we really define the global financing framework that is going to deliver on national development goals for Africa, on regional integration, and the sustainable development goals? So if you were to think through exactly what we need to have in the Addis Accord, and we have right now a clause on MIGA, I don't think we have one for OPIC, or MCC, but what is it? We've had 3 days of meetings, starting with the NEPAD beta projects, the challenges of project development yesterday, how do we really create the pipeline of bankable projects? How can we crystallize and anchor the key concepts that need to change the paradigm so governments, DFIs, bilateral partners, and the private sector work together more effectively to deliver on energy for Africa? Thank you.
Well, there's your challenge. Who wants to go first?
I'll just say one thing, if I may, and that is there's still a surprising level of suspicion about the private sector in the community around FFD, which I find unsettling, despite the fact that we know that some unfair transactions have harmed the reputation of the private sector in some government circles for good reason. But that being said, the level of distrust, I think, is higher than it needs to be amongst those circles about the private sector. I thought we all already agreed and understood that these problems can't be solved without the private sector, and that the public and private sector need to work together to share risks and deliver on it. So I feel like we have some more work to do in terms of explaining the role and the positive role of the private sector. And I think that businesses, busy as they are, and much as they need to focus on their own bottom line, need to engage with the FFD more than they have so far.
Yeah, I cannot agree more with Elizabeth, but I think I have to give you one number. It's already, private investment into Africa has charged over 50% of its financing. That I definitely personally see PPPs are increasing mainstream. First of all, we cannot really ignore private. And at the same time, we are saying we need more investment. And unfortunately, a lot of G7, G8 countries are facing fiscal deficit. So, a lot of agencies probably not are dreaming about 15% budgets. So therefore, I think we really need to think about it, how to motivate private investors to coming in, and we really need to trust them, unless otherwise they are not really coming in. Then I think risk mitigation of course have to come in. At the same time, private investor side, I think are willing to take some risk. But private investor, we cannot really talk about one private. I think private investors are kind of different risk return profile. Obviously, savvy investors, of course we talked about today a lot of James, but Helen, you are also very, very heavy investors. They are willing to take relatively larger risk, but they need a relatively larger return. But different type of the investors, such as pension funds or insurance company, can probably live with moderate returns, but they really need a risk mitigant. How actually we just combine those, and how we can actually sort of structure the deals in a way that we can provide mitigants to combine those middle or low risk, low return type of investors here is probably the key for post 2015 financing for developmental agenda to be discussed in Addis.
Dana, do you want to add anything?
Sure. So, it's a complicated question. I do anticipate that there will be a focus going into Addis on some of the cross enablers of development and development finance. None of which in and of themselves solve the problem, but when we think about the focus on data, on transparency, on a topic that we haven't discussed much this week, which is the role of women and women's economic empowerment and gender, and on scaling innovation. So I would expect that there would be discussion and specific proposals in the cross-enabling environment to look into this year and the next 5 years and 10 years of how we can make big shifts and big moves in those areas.
Thank you. Well, obviously, James and Kevin, the onus is on us to make our voices heard in these fora. Also, Kevin, you mentioned reputation being very important. James, you were very upfront with the costs of your project. I have been equally upfront in different conferences about the returns that we as the private sector are taking out of our projects, why we need that level of return, which I have to say is nothing like what we heard about the Kenya Corridor project earlier today. I was astonished at the level of returns that they were offering from that project. It's not what we normally see. So with that, I think I should let you all go. And thank you very much to my panel. They will be here, so you can certainly buttonhole them and ask them more questions, but I don't want this to drag on too long. So thank you all very much indeed.
But please don't get up. Okay, first of all, we want to thank our leaders who are leading us into a new needed paradigm. But I'd ask you to stay just for a second. So please join me in thanking Helen and her wonderful star-studded cast.
Doing business in Africa. You can't afford to be without Africa Investor.